Hello everybody, this is Ilya Spivak, currency strategist with Daily FX, and we'll be doing our outlook for the financial markets for the week. Before we get started though, if everybody can please type into the chat box, let me know if you can hear me, and let me know if the video is coming through okay for everybody, and we will get started. Alright, looks like we're in good shape. So let's first and foremost take a look at what we have here starting off the week. You guys will probably notice the Australian dollar is doing particularly well here at the start of the week, outperforming, and that follows the release of Chinese non-manufacturing PMI data over the weekend. You can see the Aussie dollar here correcting higher to retest this channel bottom, having initially broken down through it last week. Support coming in here at 94.09, which is the 38.2 fib of this entire advance. And if we were to sort of work our way through this channel bottom, now coming in about 94.98, so call it roughly the 95 figure, you have a cluster of support at this former top, 95.22 right here, and the 23.6 fib at 95.42. You can also see the Japanese yen moving lower here. You can see dollar yen is edging slightly uh, downward, but as you look elsewhere in the yen space, for example, sterling yen is up, euro yen is up. So you're seeing the yen uh, somewhat weaker, of course, especially Aussie yen, as you get a pickup in risk sentiment surrounding this better than expected Chinese PMI number. The number came in at 56.3. That's actually the highest since August 2012. So a very strong service sector number from China. We do have a lot of event risk coming up this week that may potentially jostle markets, but one of the most significant considerations still as we look through the financial markets landscape is the debate on when the Federal Reserve might move to taper its QE3 program. And of course, as we look at this, we have a number of critical announcements this week, starting with the non-manufacturing ISM number. That coming across the wires on Tuesday, expected at 54 versus 54.4 in the prior month. Now, what we can see here, this is a chart of the Dow Jones FXCM US dollar index. You can see we've made a significant move higher, broken through this resistance at these falling trend lines here, taken out the 23.6 fib at 10.509 and exposed the 38.2 level at 10.604. If we take a shorter term view of this, we can see the next near-term objective after we cleared this fib here, the 38.2 fib of just this chunk of the move. The next barrier here, shorter term, coming in at 10.583, followed by the underside of this line right here that acted as support, recast as resistance here, and likely to act as resistance again here, reinforced by the 61.8 fib at 10.637. So those are the critical levels that we're going to be looking for. And of course, as far as interpreting economic data, the theme continues to be bad news is good news, as it were, because what the markets are taking away from negative or slowing economic data is that the Fed is likely to maintain its stimulus effort for longer, which is being reflected in assets as a risk appetite positive type of development. So if we were to see a softer ISM, for example, that would likely see the US dollar weaken, but it would likely see strength in things like stocks, commodities, and really the spectrum of risky assets. In the FX space, of course, the focus would be on something higher yielding like the Aussie or the Kiwi. But generally speaking, you might expect that in an environment where you get softer U.S. data, the most significant feature would be a weaker U.S. dollar, which of course translates not only into weakness against the major currencies, but also translates into a pickup in demand for anti-fiat assets, notably, of course, gold and silver. So as you look at gold here, let's refresh this chart. You can see here as you look at the daily chart for gold, you've seen a bit of downward resumption here on gold. This chart is still taking its time to load here. Let's see if we can't speed it along a little bit. Here we go. So here's a daily chart of gold, and again, you can see that we've started to come off once again, and we've taken out the initial fib support here at 1318.73, the 23.6 level, and it opened the way down to the 1300 figure as well as the 38.2 fib at 1292.15. But this may yet find swift support if we get soft U.S. economic data that encourages a view on quantitative easing that sees tapering relatively later. With silver, we're also coming in to support here. If we take a look at sort of roughly where this trend line may fall, you can see that actually there's probably about a layer of support here, whereby if this is sort of how it falls along the wicks, you can see right here would be sort of how it would fall along the candle bodies, where this would be a sort of range of support down here. And as you can see, you're coming right into this area at the moment. So an opportune place perhaps for silver to recover, although of course we don't know that yet, but weak US data would be something that would help to catalyze that. Looking at crude oil, as we just mentioned, we're right at support on crude oil as well. We've made the move down to this channel bottom, and so we will see if we're able to push off from this level in the event that we do get U.S. data that falls short of expectations. After the ISM number, of course, as we look deeper into the week, the event risk only gets more significant. On Thursday, we have the U.S. third quarter GDP number. Expectations there for a bit of a slower outcome, down from 2.5% annualized growth rate to 2%. And through the rest of the week, of course, on Friday, we have the critical non-farm payrolls number for October. The important thing here, obviously, that we are going to get the first glance at the impact of the government shutdown, which we did not see, of course, in its sort of true form in September. Obviously, the September number was somewhat softer, but that arguably was more so about a reticence to hire on the part of businesses, uh, essentially reflecting the uncertainty over the government shutdown. The October numbers would actually show us the impact of the shutdown itself. So it would show us to what extent the layoffs really started to hurt growth. So that would be something interesting to see, of course, and an important gauge for expectations of quantitative easing. The market's forecast calls for an increase of 125K in payrolls. That's down from 148K in September. For the unemployment rate to edge higher from 7.2 to 7.3%. And clearly, again, an outcome that would be as soft as expectations suggest would likely uh, weigh on the US dollar and likely boost risky assets as we sort of attempt to handicap when we might get the first move to scale down QE. Through the rest of the week, there's of course more event risk than just that out of the U.S. There's quite a few uh, releases that are very high profile out of Australia. Of course, tomorrow we have the RBA rate decision. Expectations are for the RBA to keep rates unchanged once again. That would sort of fall in line with expectations that are being priced into markets. Markets, as I wrote in my weekly forecast for the Aussie, baking in a meager 4% probability of a change in the baseline rate. So at this point, we have a situation where the policy statement is really going to be of critical importance because it will be um, relative policy expectations rather than an actual move in in rates that is going to be significant. Similarly, for the rate decisions due later in the week, we have a policy announcement from the BOE, we have a policy announcement from the ECB, and critically, uh, I mean, the BOE is likely to be another non-event first and foremost. Um, Not really a whole lot to talk about there, considering the recent trends in UK data have been relatively stable. The overall outlook for the economy has somewhat deteriorated as we've seen softer economic data overall as it falls relative to expectations, which suggests that the market had been more optimistic about UK economic growth than was the reality. In fact, data has been outperforming expectations since, or underperforming expectations rather, since late August. So, essentially, from about the time when the BOE unveiled their guidance based framework, which was around August, you've seen economic data actually do worse relative to expectations, suggesting that the BOE was actually more so on the money with their assessment of the economy and their belief that they're not going to hit those critical thresholds that they've established for themselves to potentially reconsider being accommodative, that they're not going to hit those for a while. The market had been more optimistic, and actually sterling rallied back when those thresholds were announced on the belief that's basically this rally right here. That's the belief that essentially the Bank of England is going to have to hit those thresholds much sooner than the bank itself thought. Well, clearly, it's seeming at this point like the Bank of England was right and investors were overly optimistic. So, although that suggests that the British pound has room to correct lower, it does not suggest that the Bank of England really needs to do anything to change policy because reality seems to be closer to what they thought than what the markets thought. So it's the markets that have to do the adjusting, not the Bank of England. So we're really not expecting anything material at all from the Bank of England this week. The ECB is a bit more of an interesting case, and I can already see we have a bunch of questions here on the ECB and the impact that it might have. So let's take a look at the euro and let's talk about the ECB, because here what you have is a potentially interesting situation. Obviously, we had a dramatic decline in the euro last week, really across the board, after we got those very, very low inflation figures and just an overall disappointing set of economic data throughout last week. Uh, PMIs came in softer. Uh, the the inflation number, as I mentioned, fell below 1%. So really very, very soft data, which encouraged, incidentally, as we suspected, the return of dovish ECB policy expectations. And the idea that the ECB might introduce some kind of accommodation. Now, critically, although the markets are certainly talking of rate cuts, a rate cut would actually not do a whole lot for the ECB and really would not introduce any kind of significant easing. Now, why is that? Because if we take a look at where current market rates are, we are actually running substantially below the ECB target rate. So the overnight target rate for the ECB is currently 50 basis points or 0.5%. That's overnight. The 3-month Euribor, which is the 3-month benchmark for the euro area for borrowing in euros, is actually at 23 basis points. So consider that obviously rates over a longer period should be theoretically higher than rates over a shorter period, because lending to someone over a shorter period represents a smaller amount of risk, right? The longer the period that you lend to somebody, the more opportunities they have to become unable to pay. That's why longer term rates are higher than shorter term rates normally. In this particular situation, the market rate for euros over 3 months is actually almost less than half than the overnight benchmark rate. If we compare apples to apples and look at the overnight market rate for euros and compare that to target, the difference there is even more stark. The overnight market rate for euros is uh, at about 10 basis points and has basically oscillated between about 6 basis points and about 3 uh, or about 30 basis points rather, basically for the past year and a half. So we're talking about a dramatically, dramatically lower rate than what the actual benchmark is, which raises an interesting question, right? If we do get a rate cut, what does that mean? Is that in any way, shape, or form a meaningful kind of easing? Which, of course, it is not, right? Because effective market rates are already below benchmark. You can already borrow much cheaper than the ECB target rate. So the impact of a rate cut here, in practical terms, would be effectively moot. So the question is, if inflation in the euro area is in fact low, do you need more than a token gesture, which a rate cut would be? So the question then becomes, what other alternatives does the ECB have to really create some actual easing, and will it, as it's done before, essentially rely on rhetoric, which has not been so successful. Right? The ECB has clearly told us with the Eurozone debt crisis, don't worry, there's enough firepower, we'll do whatever it takes, and the markets believed them because that was essentially a situation governed by sentiment and rhetoric, was effective in job owning sentiment. But when you look at something dependent on the actual economy on which there is data, and you attempt to use the same kind of rhetorical device as your main policy tool, as the ECB has attempted, basically saying, don't worry, the easing will be sufficient. Well, inflation numbers don't agree. And inflation numbers aren't the sentiment, they're fairly hard data. So at this point, the question is, well, what can the ECB do to really physically ease financial conditions? And obviously, besides a rate cut, the natural first inclination is to expect perhaps another LTRO, although that's probably a bit too drastic of a first step. One option that actually my colleague Chris has been talking about is something equivalent to the Bank of England's funding for lending scheme, where what the central bank does is it provides liquidity directly into businesses. So rather than easing borrowing conditions in the banking sector and then relying on banks to transmit those lower borrowing costs to the wider economy, what the funding for lending scheme or some Eurozone equivalent of that would entail is providing credit directly to enterprise, directly to businesses. So that's another possibility for creating credit and loosening financial conditions to get inflation a bit higher and to get credit and capital moving around. So those are sort of the possibilities. It's unclear whether the ECB will actually embark on something in the immediate term because, of course, they're still engaged in this bank asset review that they're discussing, essentially doing stress tests on the region's banks and reviewing the assets that they have on their books to determine if institutions in the region are adequately capitalized. And they've said that they don't want to ease until they figure out if the reason that capital is not flowing to the economy, the reason that the policy transmission mechanism in the euro area seems to not be working, if that's a supply issue, meaning the banks are not supplying adequate credit, and if the reason that they're not supplying it is because they're under collateralized, or they're essentially concerned with the stability of their portfolio, and therefore they want to keep cash on hand to cover any potential losses, or if the issue is a demand issue, meaning people actually don't want to borrow, which would obviously be a very different kind of situation. So as we look at this, uh, we're probably not going to get an actual move from the ECB to change policy in the near term. We're probably going to get rhetoric suggesting which one of these options might be the way that the ECB is looking to go. So the critical consideration, as always, is going to be less so the actual outcome of the rate decision, though, of course, if there is a surprise cut, you're likely to see the euro go dramatically lower. But the critical component, as it's been dominantly over recent months and years is going to be the press conference from ECB President Mario Draghi and what he says and how he essentially guides the market's thinking on where you're likely to see the the uh, the ECB actually attempt some sort of easing effort. Another option that that has been talked about would be negative deposit rates on the ECB deposit facility, where the banks would actually be charged to keep money on deposit with the ECB, thereby sort of punishing them for not lending and getting money out and getting excess reserves out. So that is yet another consideration that we need to be watching for. So we'll see how the ECB guides the conversation. But if there are no meaningful announcements about future easing, if there is not a meaningful shift into the dovish direction from the ECB at this policy meeting, we are likely to see the euro recover dramatically. Because just like we've had aggressive easing expectations built into markets ahead of last week's FOMC, so too we have aggressive easing expectations built into the markets ahead of this ECB meeting. And just like those expectations were upset by the Fed, pushing the US dollar dramatically higher, so too we might see the euro rebound aggressively as we approach this support here at the bottom of this channel in the 50% fib at 134.68. If we get an ECB that does not overtly signal easing to come. Now, I'm looking at the euro on a weekly basis, and here's the chart that I'm watching right here. You can see that this is the long-term euro downtrend all the way from April '08, and it's been carving out this channel. I'm looking at this support right here. We actually held this trend line last week as we dove lower. So if the ECB is seen as less dovish than the markets ideally expect, what we might be looking at is a bounce from here to give us a better entry opportunity short off the top of this channel. So that's what I'm going to be watching for as far as the trades setup that I want to be looking at this week. The situation in sterling dollar, again, looking at it on a weekly basis, it cleared this trend support here, but it's retesting this former resistance, now support at the trend line back from April 2011. So what I'd like to see here is confirmation of a reversal on a close through this. You'll notice on a daily chart, you're also squarely at support at the 23.6 fib at 59.18. That's the fib retracement of this advance. So waiting for confirmation here as well to potentially get short. Rounding out event risk for the week, we have Australian employment figures on Thursday. Expectations there for the unemployment rate to tick slightly higher to 5.7%, for the jobs increase number to stay very close to the prior month. 9K recorded in September, 10K expected in October. And rounding out the week on Friday, we have Canadian employment numbers as well as U.S. numbers, although the Canadian release is probably going to get vastly overshadowed by what is going to come out of the U.S. And over the weekend, we're going to get Chinese CPI numbers, but those we'll talk about in next week's weekly forecast because markets will be closed as that number will be coming across the wires. Obviously, in as much as FX markets are over the counter, they don't physically close, but with most of the world's banking sectors closed, liquidity is going to be uh, almost nil. So the real response is likely to feature as markets begin to come back online. Uh, Asia Monday morning next week, so about a week from right now. Let's go ahead and take some of your questions here. One guest is asking, what is your view on euro dollar technically, and could we show a good entry for a long position? Well, no, you can't show a good entry for a long position, as far as I'm concerned, until you actually see one. I always stress that it's really not about price as it is about the setup, right? Price ultimately is just a number. Nothing about 134.68, say, is necessarily important just because after the decimal point there is a 3, a 4, a 6, and an 8. Right? There's nothing inherently magical about that number. What's significant about it is it's a former bottom here. It seems to be a fib, and it seems to coincide closely with the bottom of this channel. But it's the fib, the channel, and probably most importantly, the range bottom here, why it matters. It's not so much the level itself. And incidentally, this line is a line that I've seen drawn not only by some of my colleagues, but some of the people that tweet me their setups as well, uh, to get feedback, to share ideas, and this is another line that people have set up on their chart that also is a consideration here, and also, as you can see, reinforces this cluster of support. So I think really, if you are talking about a technically attractive long position, you need to first get some sort of indication that prices are getting ready to reverse higher, which at this point you don't have. There's nothing here that necessarily says that you're going to reverse. What you've had is two big pushes down, and nothing suggesting that you're going to necessarily bounce here. Nothing says that you can't have a small wick higher and then another major push downward. In fact, both of these candles, as you can see here, have small wicks higher, suggesting they actually attempted to advance before this plunge. So I would be very careful here about attempting to pick this bottom. Same thing for one of our guests here saying that the RCI, I think our guest means RSI, is extremely low. And again, I would want to actually see price actually do something to show me that there is a reversal that's likely to occur here. An oscillator being low does not necessarily tell us a whole lot of anything. It can be low for a very long period of time, especially if the market is trending. Because remember, what RSI is a ratio of closes higher to closes lower indexed over time. So if something is trending down, it is of course more liable to close down than it is to close up, which means RSI is going to necessarily go down, just by the way RSI is arithmetically structured. So you want to be very careful about assuming that just because RSI is low, that the market is going to necessarily find that as a reason for recovery. That's not necessarily at all the case. That really is essentially a range bound kind of strategy. But what we're looking at here is doesn't look at all like a range. It looks like a trend that's developing. So I would be very careful about taking that a uh, as a indication of anything specific. There's quite a few questions on Aussie dollar here. Let's take a look back at Aussie dollar. Those of you that have been following my trades will know that I actually entered long Aussie dollar right here and booked it last week, right over here, uh, ahead of the FOMC meeting. Booked about 230 pips on it, and at this point, looking for the next setup. It's unclear at this point whether what we have here is a reversal back downward. As we can see here, the trend is downward sloping. So we do actually have a downtrend bias to this overall. We were tactically long, basically uh, trading this bounce here. And if we sort of consider resistance somewhere in this area along these bottoms here, then this would be a very logical place from which we would return lower. Notice also right at the same spot, and we'll put these in red so you guys can tell the difference here between expansions and retracements. Notice the 50 fib is also right here. The 50 fib retracement of this move down. So this basically erased about half of this decline and now seems to have turned lower. So it would appear as though we may have the start of a new downtrend here, or at least the resumption of this downtrend, the start of a new leg of this downtrend. At this point, I don't think we have a very compelling entry point. If we were looking to get in here, the stop would basically be this high. That would be 97.57 up here. And as you can see, the initial target would probably be somewhere in this area, between this 23.6 fib and either the top of this candle or the top of or the bottom of this down here, where essentially this resistance is recast as support. But either way, we really don't have compelling risk reward to enter long at this or to enter short at this point. So I'm going to actually stand aside here for the time being. If we look at a daily chart of Aussie dollar here, you can see that we're actually retesting this channel, and if we do actually see some sort of an indication of reversal here, we may get a bit of a shorter term setup as we test into this resistance, but for the time being, nothing suggests that we're going to necessarily get a compelling setup here. So until I see it, I'm going to stand aside and actually allow things to develop. One guest is asking, or rather saying that he noticed that dollar Swiss is in a downward channel, almost hitting resistance. Asking to go over that. We can absolutely look at dollar Swiss. Here is dollar Swiss. This is a daily chart of dollar Swiss, and as you can see here, we are in fact approaching resistance here, but I wouldn't call this a downward trend. I would call this a wedge, and in as much as this is a wedge, it could be pointing to an upside reversal. It's not a very well defined wedge. It's not as extremely sloped as you might sort of hope a wedge would be, but it does certainly appear to look like more so a wedge than, let's say, a channel. And so, with that in mind, we'll set this up like so against these bottoms and against these bottoms here. So it looks to be more so a wedge type setup, which actually would be indicative of an oncoming bullish reversal, as it seems sort of may have started here. But where I would be concerned is with this line here, the trend line from February 2012. This was a major level of support that was clearly taken out here. And so in the context of the break through this support, this actually looks corrective. So we'll have to see if we actually get the break, I would argue, of this area, basically around the 92 figure, so we can get not only through the wedge and not only through these fibs, but also through the trend line right here before actually going with a long position on dollar Swiss. Although certainly the case for this bounce does look compelling. We have positive RSI divergence here, and the wedge structure here does suggest that we have scope for the upside scenario here. Let's see, what other questions do we have here that we haven't covered yet? A couple questions on the Kiwi. Let's take a look at the Kiwi. Here is a weekly chart of Kiwi dollar. And you can see that we have this dominant rising trend right here. We came to retest this underside of the rising channel that guided the pair all the way back from late June of 2012 through about May of 2013, so almost a year in here. And there's a very, very dramatic looking bearish engulfing here, obviously, at the bottom of this channel, suggesting that we're getting ready to reverse back lower. But as it stands, we don't yet have compelling risk reward parameters to actually enter the trade at this point. Notice we're right at this support here where we found support before, down here, guided by the 38.2 fib. You can see it's also roughly along these bottoms here. So some kind of a critical level here, most likely, and we'll have to see how this develops because certainly shorting directly into a support level seems hardly a good idea. If we take a look at a daily chart here, you can see that likewise on the daily chart we're also right at support. That's that same fib at 82.14, and you can see we're holding it fairly consistently here. Micah was asking how reliable is RSI divergence. I mean, you can't really put a number on reliability for RSI divergence, nor would I use it as a standalone indicator, much less a dominant indicator. It's essentially just a layer of confirmation. And it's best to think about it in terms of sort of understanding what RSI is. Again, it's a ratio of closes higher to closes lower. It's not a sort of a magical thing that has a X probability of being correct. If you just sort of think about what divergence is and what divergence shows, that's a lot more powerful of a tool than sort of trying to guess what its reliability percentage is. All that RSI is ultimately telling you is what is the average. In this case, it's a 14 period RSI, so you're averaging 14 uh, 14 candles. In this case, this is a daily chart, so you're averaging 14 days. And so all you're really getting with RSI is the average close higher over a 14-day period over the average close lower. And if something is more liable to close higher, obviously the numerator of that ratio is going to be bigger and rising. Whereas if something is more liable to close lower, it's going to uh, grow the denominator, and the ratio that makes up the RSI line is going to decline. So if you look just in terms of arithmetic, what creates RSI divergence? What happens is the price is more liable to close in the opposite direction of extremes being set on the chart. So the prices, in this case, for example, where you had RSI divergence right here, right? So you had a lower low on RSI, but a higher high on the price. All that's telling you, just in terms of simple mathematics, is although the price is setting a higher high, its ability to close higher is degrading relative to its ability to close lower. So it's creating a sense, just numerically, that bullish momentum is fading. Is it the only indicator you need? Of course not. But it helps as a layer of confirmation. Okay, so I think we've basically covered everything that we had to cover here. We went over all the majors, went over all of the major themes and events. So we'll call it a day here. I want to remind everybody that if you have anything that you'd like to follow up with me on, you can always feel free to tweet me or direct message me via Twitter at Ilya Spivak. If you would like to sign up for my email distribution list to receive my trade setups and articles and all that good stuff, you can click this link here. Here, by the way, is the updated link for my Aussie trade from last week, where I the one that we discussed earlier, the one I booked profits on last week. Uh, I'm going to be back tomorrow to cover the outlook and the release of the RBA policy announcement. So do come join me for that. I'll be posting this session up on the website. So if you missed any parts of it, like I see Robert is asking for an outlook on crude oil, which we've already covered. So you'll be able to see that there. Thank you, everybody, for joining me, and I'll speak to you guys tomorrow. Take care.